Hi there, this is Hugo. Everyone is terrified of a temporary Amazon policy change right now, and because of it, Wall Street is handing us a dominant toll bridge software monopoly for the price of a stagnant survivor. Let's see why the market is dead wrong on this one. If you want to understand SPS Commerce, imagine you're a rapidly growing snack brand that just landed a massive contract with Walmart or Target. To actually sell to them, you need a standardized digital way to process orders, shipments, and invoices. SPS Commerce is the digital plumbing that provides that exact connection across 300,000 trading partners. What got my attention is the sheer overreaction in the stock price. Wall Street is hyperventilating over the expected loss of 4,000 low-value third-party accounts tied to Amazon. In their rush to sell, they are completely ignoring that the underlying business is an absolute compounding machine with deeply recurring revenue. Let's look at how the cash comes in the door. Their heavy lifter is the cloud-based fulfillment platform, which handles order data automatically. They also make money on analytics, assortment tools, and a revenue recovery business that helps suppliers dispute and recover unfair deductions from big retailers. This is a beautiful software as a service model. They don't sell you a box of software once, they rent you the connection. Once SPS is wired into a supplier's core ERP system, the pain of ripping it out is incredibly high. That stickiness is why 96% of revenue recurs year after year. We are looking at a market cap of $2.19 billion spread across 37.52 million shares, operating squarely in the technology sector. I always want to know what could kill a business. For SPS, I'm tracking 5 specific risks. First, policy changes at Amazon are causing headaches for their revenue recovery business, leading to an expected churn of up to 4,000 suppliers. Second, operating costs are rising, eroding margins. Third, there are complaints they rely too heavily on share repurchases. Fourth, top-line revenue decelerated recently. And finally, the genuine threat of new AI-native tech startups disrupting the traditional supply chain model. The market looked at all of this and ran for the hills. Q1 GAAP net margins dropped from 12% to 10%. Q1 revenue of $192.1 million slightly missed analyst estimates of $196.6 million, and the words 4,000 customers churning triggered a massive sell-off. But here's what the sellers are missing. Management is intentionally introducing a $19.99 month subscription fee to weed out the smallest, unprofitable Amazon accounts. It's a strategic cleanup, not a mass exodus. The margin erosion? Free cash flow margin sits at a spectacular 21.9%. The top-line deceleration is entirely localized to the Amazon segment, while the core business just celebrated its 100th consecutive quarter of growth. And the buyback dependence? When your stock is this cheap, buying back your own shares is the highest return investment you can make. Disruption is a real long-term threat, but at today's prices, the market has already priced that risk in. Let's strip away the accounting noise and look at the real owner earnings. Starting with operating cash flow, we subtract stock-based compensation because diluting partners is a real cost. We add back the working capital timing drag, then subtract maintenance capex using a 5-year average and a small working capital reinvestment amount. After all the real costs, this business put $154.07 million in our pocket. Divide that by our 37.52 million shares, and we arrive at a robust $4.11 in owner earnings per share. This network effect creates a powerful compounding machine. Over the past 7 years, owner earnings have compounded at 24% annually. Revenue has climbed steadily from $451 million 5 years ago to $762 million today. They achieved this growth while maintaining a fortress balance sheet. They are sitting on over $147 million in total net cash, completely insulated from interest rate panics. And because this is an asset-light model requiring very little capital, management acts like true owners. They deployed $47.1 million in Q1 alone directly into share buybacks, quietly increasing our slice of the pie. Before we value any business, we ask 4 questions. First, do we understand it? Yes, they are the indispensable toll operators for the retail supply chain. Second, are the economics durable? Yes, with 96% recurring revenue and high switching costs, the cash flows are predictable. Third, is management honest and capable? Yes, they deployed nearly 100% of Q1 free cash flow to buybacks at depressed prices. Finally, is the price attractive? Yes, at an inferred multiple of just 13x, Mr. Market has handed us a dominant compounder at a bargain. Let's run the math to see exactly how cheap this is. We take our owner earnings per share of $4.11 and apply a highly conservative 15x multiple. Why 15x? A 15x multiple implies an initial earnings yield of about 6.6%. If this business continues to grow owner earnings at even half its historical rate, our return on cost comfortably hits our 10% to 15% target. We multiply those together, then add back net cash per share. That gives us a rock-solid intrinsic value of $65.59 per share. Compared to the current market price of $51.17, we have a margin of safety of 22.0%. We are buying a wonderful business that normally commands a massive premium for the price of a stagnant survivor. My final verdict is a clear value opportunity. Temporary headwinds in the Amazon segment are masking a 100-quarter growth streak. We are getting a sticky asset-light compounder at a reasonable price. Now, at today's price of $51.17 with a solid 22.0% margin of safety, we are approaching the buy zone. If you believe in this business, consider building a position here or sell cash-secured puts at the $49 strike to collect premium while you wait. You get paid to be disciplined. As always, this is just my analysis. Do your own homework before buying any business. If you enjoy looking past Wall Street's noise to find real owner earnings, make sure to subscribe. Thanks for watching, and I'll see you in the next one.